What's up everyone, it's Scotty with MoneyVest. So today we're going to be talking about Palo Alto Networks, ticker symbol PANW. They are going to be reporting earnings next week on Monday after the markets close for the third quarter fiscal year 24 for their actual earnings here that are going to be reported. So in this video, I'm going to break down everything you need to know about Palo Alto Networks in terms of earnings. It is one of the best cybersecurity companies out there next to CrowdStrike and Fortinet as well. So as always, make sure that you drop a like and subscribe to the channel. I'm also going to be breaking down my intrinsic value on this stock, on this company. It's actually one of those stocks that I do want to buy along with Fortinet for the long term in the cybersecurity space. But it's just never been trading at my intrinsic value, or the valuation's been always too high for this company. I actually did have CrowdStrike for a trade idea last year that I sold for a very nice profit, but I've been looking to buy another cybersecurity company. Fortinet is another one that I may look into next week. I think it's time to start looking into that one, start buying as well. And Palo Alto Network is a very close second because it's the company that's the biggest in terms of revenue generation. So as always, make sure that you drop a like and subscribe to the channel. Again, links to our Discord and Patreon is going to be down below if you're interested in joining us. And again, 50% off all individual courses. Coupon code is going to be May50. And also join our Patreon with a 16% annual discount available until the end of this month. You get access to over 50 plus private videos and tutorials, including my entire 30 stock shopping list with my buy targets and the MoneyVest index, which I think is very, very useful and about a game changer in our decision making. Helps us understand where the risk reward is, and also all the Discord channels, including trade alerts, trade ideas, options alerts as well. So first things first, Palo Alto Network is going to be reporting earnings for its fiscal third quarter after the bell on Monday, with investors likely watching sales amid concerns about reduced customer spending. And the cybersecurity company could also provide updates for its platformization strategy in its effort to become a one-stop shop for cybersecurity. So in terms of expectations, we're looking at $1.97 billion, a little bit under $2 billion in revenue. That's going to be a slight decrease from the second quarter fiscal 24, but a decent increase compared to third quarter fiscal year 23. So 1.72 billion growing to 1.97. When it comes to earnings per share, 40 cents per share is what they're expecting compared to 31 cents same time last year, and net income of about $143 million compared to $107.8 million for the company as well. And again, business spotlight updates on the platformization play. Palo Alto Network has emphasized its focus on the platformization, consolidating cybersecurity services on its platform and bundling offers to become a one-stop shop for clients. And as part of this strategy, Palo Alto Network has offered incentives such as discounts and deferred payments to draw clients away from rivals and onto its platform. And the company has also made a number of recent acquisitions to expand its offering, announcing its latest on Wednesday with the purchase of IBM's QRadar SaaS assets. Jeffrey analysts said that they viewed the deal as a modest positive, further cementing Palo Alto Network's ecosystem lead as well. Now, when it comes to the overall revenue, I mean, this is one of the best companies out there for cybersecurity. They've been extremely consistent with the revenue growth and gross profit growth as well. And of course, becoming profitable as of last year, fiscal year 23, net income of just shy of $500 million. This right here is going to be the balance sheet. Again, total assets do exceed total liabilities, with the current net debt sitting at just over $1 billion. So we got more cash than debt on the balance sheet, more assets than liabilities on the balance sheet. Current ratio and quick ratio is also over 1 for the company. And free cash flow, I mean, just take a look at this growth here. Very, very strong free cash flow growth, going to over $2.6 billion as of fiscal year 2023. And trailing 12 months, we're sitting at just under $3 billion for the company as well. If you come over to some of the other margins, return on assets, 14.5%, return on equity, almost 90%, return on invested capital of a little bit under 80%. Gross margins are strong, 74%. EBITDA margins at 6%, net margins over 88% for the company on a current basis. But of course, on an annual basis, it is going to be a little bit lower for the company at around 6% in the last year, as well as they just recently became profitable after turning the corner finally. As I said, actually quick ratio, current ratio is a little bit under 1. On a quarter basis, might be a little bit higher. So let's just check that. So 0.79 is where we're at. But again, debt to free cash flow, really, really low. Debt to asset ratio and debt to equity ratio also really low for the company at under 1, and that's exactly what we like to see. Now, if you come over to the expected revenue and earnings, they are expected to grow earnings per share from about $4.27 to as much as almost $7 per share by 2027. That's going to be a reasonable growth rate, not super high, but it is still considered as a growth stock. And revenue expected to go from about $7 billion to almost $13 billion. So it's going to be over 80%, 85, 90% growth rate for the company on a 4-year basis for this business. Now, if you come over to the analysis on the fundamentals, so if we're expecting a net income on a non-GAAP basis of $1.8 billion for the business, right? So $1.8 billion on a non-GAAP basis. And if we apply a growth rate of, let's say, 20%, and we give them a P multiple, which again, if you come down to check the valuations right now, you'll notice that they're trading at almost 50 times earnings multiple and 15 times sales, which I think is very, very high for this company, and 37 times cash flow. So these are all metrics that, in my opinion, are very expensive for Palo Alto Network. Even though I think the growth rate is pretty strong, still the valuations are a little bit higher, very similar to what we have noticed for NVIDIA, for CrowdStrike, for a few other companies. I think Fortinet is one of those cybersecurity companies that's coming down to far more reasonable levels than compared to Palo Alto. But if you go with, let's say, 30 times P multiple over here, 12% discount rate, 10% margin of safety, little to no share buyback because, again, the share count has been pretty stagnant. In fact, if anything, it's actually gone up from 274 million to 308 million shares at the moment. We come down to a fair value or an intrinsic value of $212 per share, which would mean about a 33% downside needed in order for this stock to be trading at its intrinsic value. And this right here, of course, is going to be that sensitivity grid that you can take a look and, of course, figure out whether Palo Alto is worth buying, or whether it's based on different estimates, different P multiples, different growth rates, what's going to be the intrinsic value for Palo Alto, right? So $212 is the intrinsic value based on my estimates of 20% growth and 30 times P multiple. But of course, if you're expecting a higher growth rate, then you can expect all the way up to 250s, 290s, to as much as $300 per share in intrinsic value as well. So that's where we are. Again, they're expected to report some pretty solid numbers in the coming quarter here. They've beaten expectations every single quarter. I mean, pretty much all these quarters are green. That means they've done a really good job in beating expectations here. We were on a very nice higher high and higher low pattern, as you can already see. So this right here was the overall uptrending channel for Palo Alto Networks as it continues to trade inside this uptrending channel. And then we have obviously had a little bit of a sell-off after the last earnings, consolidated sideways, and then we now have a big resistance sitting for us at around 323. So this right here is going to be that level to keep in mind as an area of resistance. Right now the stock's coming up to its overbought levels with the RSI, the MACD, and the L3 banker oscillator. So just got to be careful here as it approaches that resistance. It's possible that company comes out with earnings, knocks it out of the park, gives us great guidance, increases their guidance, and the stock breaks out, and the next resistance pretty much is going to be the all-time high for the stock at 383. But as I said, that I would be a lot more interested at lower prices, because at the end of the day, really why I'm investing in the first place is to look for deals and to look for discounts. And if I'm not getting that, regardless of how great the company is, it's still not going to make up for a overpriced or expensive stock, right? A great company just cannot mean that we invest at any price, because pricing and valuation are perhaps the most important key indicators that determine your future returns. And Howard Marks teaches that very well in his book, The Most Important Thing. So keep that in mind. Resistance is going to be 323 all the way to 379. Support level down to 257 to as low as $213 per share for the company. Right now, we're just consolidating sideways. And those right there are going to be some levels to watch. And my fair value is sitting at 212. So this right here really would be the area of support and a very strong area of demand where I could see myself dollar cost averaging or buying Palo Alto Networks, and most likely be selling puts in and around those prices as well for this company. So hope you all enjoyed this video. Let me know your thoughts down in the comment section below. And what do you think about Palo Alto Networks? A very, very strong company in the cybersecurity space, very consistent with revenues, margins, and now turning the corner towards profitability. It's got a huge potential, but of course trading at a little bit of an expensive valuation. Excellent balance sheet, share count pretty stable, very good management with a nice ecosystem. And of course, their platformization strategy also seem to be working out. We're going to get some updates on that as well. So let me know your thoughts down in the comment section below. As always, make sure that you drop a like, subscribe to the channel. And again, links to our Discord and Patreon is going to be down below with that 16% annual discount. As always, happy investing. I'll see you all in the next video.